studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunky died.
This slide introduces one of the most valuable concepts in advanced RRSP planning. Many people assume that every RRSP deduction creates the same benefit, but that is not true. The value of an RRSP deduction depends largely on the tax rate that the deduction offsets. In other words, the same RRSP contribution can produce very different tax results depending on when it is claimed. Let's start by looking at the center of the slide. Notice that both individuals make the exact same RRSP contribution, $10,000. The contribution amount is identical. Nothing changes about the contribution itself, yet the tax benefits are very different. Why? The answer lies in marginal tax rates. On the left side of the slide, we see an individual in a lower tax bracket. The RRSP contribution still creates a deduction. The deduction still reduces taxable income, and the individual still receives tax savings. However, because the deduction is offsetting income taxed at a lower marginal rate, the value of the tax savings is more modest. Think of it this way. If a deduction removes income that would have been taxed at a relatively low rate, the tax reduction is also relatively low. That is why the tax savings meter on the left side shows a moderate result. Now let's compare that to the right side of the slide. Here we have another individual making the exact same $10,000 RRSP contribution. But this person is in a higher marginal tax bracket. The deduction is now offsetting income that would otherwise have been taxed at a much higher rate. As a result, the tax savings generated by the same contribution are significantly larger. Nothing changed about the contribution amount. The only thing that changed was the tax bracket. And that is the key lesson of this slide. The value of an RRSP deduction depends on the tax rate it offsets. This idea is one of the reasons why experienced advisors think differently about RRSP planning. Many people focus only on making contributions. Professional advisors focus on maximizing the value of the deduction. They ask questions such as, what tax bracket is the client currently in? Will income be higher in the future? Would the deduction create more value if used later rather than today? These questions help determine not only whether a contribution should be made, but also how that contribution should fit into the broader tax plan. The tax bracket ladders shown on the slide help visualize this concept. As income rises into higher tax brackets, each dollar of deduction may become more valuable because it is reducing income taxed at a higher marginal rate. That is why timing and planning matter. The goal is not simply to accumulate RRSP deductions. The goal is to use those deductions where they create the greatest benefit. This is where strategic tax planning begins to separate itself from basic tax preparation. A tax preparer may focus on recording the contribution. A tax planner focuses on maximizing its value. And that brings us to the key message at the bottom of the slide. The value of an RRSP deduction depends on the tax rate it offsets. Understanding that simple principle is the foundation for making smarter RRSP decisions and getting the most value possible from every contribution your client makes. This slide introduces one of the most powerful ideas in RRSP planning. Many people assume that making an RRSP contribution automatically means claiming the deduction immediately. But experienced advisors know that those are actually two separate decisions. The contribution and the deduction do not always have to occur in the same year. That distinction creates a valuable planning opportunity. Let's walk through the process shown on the slide. The first step is making the RRSP contribution. The client contributes money into their RRSP account. At that moment, they have created a deduction opportunity. In other words, they now possess an RRSP deduction that can potentially be used to reduce taxable income. But the important question is not simply whether the contribution was made. The important question is when the deduction should be claimed. That brings us to step 2, the current year. Once the contribution has been made, the advisor evaluates the client's situation. Should the deduction be claimed immediately, or should it be carried forward to a future year? Many people are surprised to learn that carrying forward an RRSP deduction is often permitted. This means the contribution can be made today, while the deduction is saved for later. And this is where planning becomes strategic rather than mechanical. Notice the advisor in the center of the slide with the message, "Timing matters." That statement captures the entire lesson. The goal is not simply to claim deductions. The goal is to claim deductions when they create the most value. Now let's move to step 3, a future higher income year. Suppose the advisor expects the client's income to increase significantly in the future. Perhaps the business is growing. Perhaps compensation will increase. Perhaps a major transaction is expected. As income rises, the client may move into a higher marginal tax bracket. And as we learned in the previous slide, deductions often become more valuable when they offset income taxed at higher rates. This means the same RRSP deduction could potentially create larger tax savings in a future year than it would today. That leads us to step 4, using the deduction strategically. Instead of automatically claiming the deduction immediately, the advisor chooses the timing that produces the greatest benefit. The deduction is applied when it creates the most meaningful reduction in taxable income. This approach helps maximize the value generated from the RRSP contribution. The result is not just a tax deduction. It is an optimized tax deduction, and that difference can be significant over time. Notice the visual progression on the slide. Contribute, evaluate, plan, optimize. This is exactly how professional tax advisors think. They do not simply ask whether a deduction exists. They ask how that deduction can be used most effectively. That is the difference between basic compliance and strategic planning. The advisor's role is to identify opportunities where timing can improve outcomes. And RRSP deductions often provide one of the clearest examples of that principle. This is why the message at the bottom of the slide is so important. An RRSP contribution and an RRSP deduction are not always the same year. Understanding that distinction opens the door to more sophisticated planning opportunities and allows advisors to help clients get the maximum possible value from their RRSP contributions. In many cases, the smartest RRSP strategy is not just about contributing. It's about choosing the right time to use the deduction. This slide brings together the most important lesson from this entire RRSP planning section. Professional advisors do not focus only on making RRSP contributions. They focus on maximizing the value created by those contributions. At first glance, RRSP planning can appear simple. A client contributes money, a deduction is claimed, and taxes are reduced. But experienced advisors know that effective RRSP planning requires a much broader perspective. That is why the RRSP sits at the center of this slide, surrounded by multiple planning factors. Let's begin with the first factor, current income. Before making any recommendation, an advisor wants to understand how much income the client is earning today. Current income affects tax brackets, deduction value, cash flow needs, and overall planning opportunities. The second factor is expected future income. Will the client's income remain stable? Will it increase significantly? Will there be a major business event, sale, or transition in the future? Future income expectations often influence whether a deduction should be claimed now or preserved for later. The third factor is the current tax bracket. As we discussed earlier, the value of an RRSP deduction depends heavily on the tax rate being reduced. Understanding today's marginal tax rate helps determine how valuable a deduction may be right now. The fourth factor is the future tax bracket. If future income is expected to be substantially higher, a deduction may become even more valuable in a future year. This is why advisors often compare today's tax situation with tomorrow's potential tax situation before making recommendations. The fifth factor involves retirement objectives. RRSP planning is not just about taxes. It is also about creating future financial security. The advisor wants to understand when retirement may occur, what lifestyle the client hopes to achieve, and how RRSP assets fit into the broader retirement strategy. The sixth factor is available cash flow. Even if a contribution is attractive from a tax perspective, it must still fit within the client's financial reality. A contribution strategy should support the client's goals without creating unnecessary financial strain. Now let's compare the two approaches shown on the left side of the slide. The basic approach is straightforward. Make an RRSP contribution and claim it immediately. While there is nothing wrong with this approach, it often overlooks important planning opportunities. The advisor approach is different. The advisor contributes, then analyzes timing, then evaluates current and future circumstances, then optimizes the deduction, and finally maximizes the overall benefit. This process transforms RRSP planning from a simple transaction into a strategic decision. The speech bubble near the top captures the advisor mindset perfectly. The goal is not just to contribute. The goal is to maximize value. That statement summarizes the entire lesson. The contribution itself is only the beginning. The real value comes from understanding how, when, and where the deduction fits within the client's broader financial plan. Notice the results listed on the right side of the slide. Larger tax savings, better tax efficiency, improved long-term planning, more strategic retirement planning, and better use of RRSP contribution route. These are the outcomes advisors are trying to achieve, not merely deductions. Better overall results. And that leads us to the key message at the bottom of the slide. Great advisors focus on the value of the deduction, not just the contribution. Anyone can make an RRSP contribution, but professional planning involves determining how to use that contribution in the most effective way possible. That is what separates strategic tax planning from simply filling out a tax return. And that is why RRSP planning remains one of the most powerful tools available to owner-managers and their advisors.